Steve Wieting is the Global Chief Investment Strategist at Citi Private Bank. He joins me on the floor. Good afternoon, sir. And we're also joined by Jeff Joerres. He is the Executive Chairman of the global staffing company ManpowerGroup, and this is a Fox Business exclusive. All right, so Steve, this is the end of the summer for the stock market, right? I mean, whether we're going to get a Fed rate hike in September or December, the market knows. Right. Liftoff is happening. Is that how you'd interpret what's going on today?
Well, I would look at it and say there is just this anticipation, this uncertainty over the Fed that is exacerbating the panic over global growth.
I mean, is it fair panic? Because we're talking about 0.25% for the first time raised in 7 years. So what's the real threat of that happening to the markets and economy?
Well, we're seeing so many reactions, very large reactions to small deviations in economic data. In China, for example, 0.3 percentage point drop on a purchasing manager's index that dropped 20 times more back in 2008, is eliciting a very, very big response. And that's partly because policy in the United States and China has been so long, so incredibly stable and on hold, and avoided making changes earlier. So we're seeing outsized reactions now.
Okay. Let me throw the question over to Jeffrey. Really loud on the floor. Hope you can hear me. I can barely even hear myself here. But what is your take on the jobs report in terms of, it's really generated a lot of debate. It's a mixed report. There's certainly some positive components. It's, the U6, the underemployed, still remains troublesome. So what's your take, and what does it say about the U.S. economy? And then we'll get back to Steve's point about the bigger global picture.
Yeah, no doubt. When you look at 5.1, you should get excited. The last time we had 5.1 was 2008. When you look at the 173,000, you're a little concerned. But, this month will probably be revised. It'll be revised up. So I think, all of this excitement, this just 173 number just gave everybody an excuse to kind of panic as a trader. What I'd like to do is to step back and say, okay, we are long in the tooth on this so-called recovery. But I see a major difference, and that major difference is when we were 5.1% in 2008 of unemployment versus 5.1% now, it was very different. So I think that the Fed and others will be looking at not just the number of 5.1, but what's the backdrop associated with the 5.1, not only overseas, but also in this country.
And what about the breakdown? What does it say about the makeup of our labor department? Manufacturing, very disappointing, and that was the first time in quite a while.
Yeah, it's not new. The manufacturing jobs for the last 8 years have been in a difficult spot. And I think what we want to do is, if we could kind of change the narrative a little and talk a little bit more about fiscal policy instead of monetary policy, because monetary policy doesn't really have the bazooka force that you would want to have, especially now. And manufacturing, I think, is feeling some of the brunt of that because it just hasn't been able to get on its feet and mature to create some of those better paying jobs.
All right, so Steve, back to China. What kind of impact is this having? I mean, the fact that there's no China trading today. So this decline of now, again, on the Dow, over 300 points. This is all about the U.S.
This is a lack of confidence in Chinese policymaking after the recent move to devalue.
Is this still about China, or is this just about the stupid quarter-point interest rate hike we're going to get?
This set this up for us. I think that the fact that the Fed is there and that the background is very, very different. One thing that's different from 2008, aside from the unemployment rate, is that the federal funds rate is zero, right? And if you look back at the last time we had international pressures, and you were feeling it with the trade-weighted dollar up 15% over the past year, that is having some impact on manufacturing. And you look back to where they were in 1997 and 1998, the federal funds rate was 5.5%. There was room for the U.S. to respond, and very much, if you look at what the Fed would intend today, it wants the slowing in the U.S. economy. The unemployment rate is falling 1 percentage point per year. That doesn't seem like the right place to have a zero funds rate. So you're not getting the help from the United States, from the policy front, while it's actually a threat from the rest of the world. So
what does that mean? So are we going to look at a global recession? Because that's the $64,000 question.
I think it's much more likely to be a panic over growth than an actual one.
But panic is actual, the way these markets translate into dollars and cents for folks, for everyday people.
If you look at what's happened to the crude oil price, that is a real downturn. It's dragging down investment in the United States. It's creating great financial distress among producers around the world. But if you looked at Chinese retail sales, they're growing 10%. If you're looking at Europe and Japan's economies, you're looking at some acceleration in economic growth. And certainly an August employment number of 173,000 that's strong enough to drop the unemployment rate is not any kind of a crisis in the United States.
Okay, so Jeff, we did see some revisions in August, which pretty much put the overall August number right on par for what economists were expecting. So what are you looking for in terms of the subsequent quarters in terms of the U.S. job market? Will we continue to see it moving in the right direction? If you consider
clearly, our last Yeah, our last employment outlook survey said, you know what, the quarter is going to be a strong quarter. It was the highest quarter we've seen in a long time. That was hiring intention. Now, hiring intention is sort of a confidence index. So with this backdrop of what's happening in China and whether Draghi is going to actually stimulate euro more and what is really happening in this country, I think the conversation has not spent enough time about small, medium-sized businesses, larger businesses, really still concerned about what's going to happen with healthcare, where are the costs going to go, what's going to happen with interest rates. So what we're seeing is an intention for high hiring, but can be cooled down if it actually starts to bubble up with more of these issues.
Gotcha. All right. Thank you, gentlemen, so much.